Walgreens have just reported their earnings, and what a report it is. We're going to dissect the information here. They did unfortunately do a dividend cut of around 48%. We're going to take a look at this in detail. As always, we're going to take a look at their financial metrics, their new dividend safety. We're going to take a look what the institutions are doing, how they're positioning themselves. We're going to see how they've performed as an industry and as a company over the last 5 years, as well as looking at their balance sheet. What is the total health of the company, cash versus total debt, and how exactly this company is performing over the last few years, as well as their bottom line. And as always, we will analyze their performance, how this dividend cut has affected their company, and based on this new report, their earnings, what is the updated intrinsic value of Walgreens, and what is our acceptable buy price given our margin of safety. So let's first jump straight into the analysis. So what we can see here on the headlines, they've posted an earnings beat, but they have slashed their quarterly dividend nearly in half. Now, this was a company that had been increasing their dividends for the last 48 years, so they were 2 years away from becoming a dividend king. Now, before we even look at the information, just the fact that they have beat on the earnings, for me, that is positive. The fact that they have done a dividend cut is also something that I personally would say is also positive. You don't want a company to paying out all of their free cash flow in dividends if they cannot sustain it, when they can look at putting that money elsewhere for the betterment of the company and investors. So let's take a look at what the earnings report essentially details. So we can see that they have cut their quarterly dividend is around 48% to 25 cents per share from 48 cents per share. And before we look at this article, something that is interesting to note, we are in the pre-market now, but we can see that investors have taken this positively. It is up around 2.3%. So when we do take a look, we can see their new dividend yield is now 3.9% for investors or potential investors, and this was before the cut around 7%, and it was one of the highest paying dividend stocks in the Dow Jones. So when we do take a look, as I mentioned, it is their first dividend cut in nearly 5 decades, so they didn't unfortunately make it to that dividend king spot. And when we take a look at the results, we can see earnings per share 66 cents versus 61 expected, so they had a beat on the EPS. Revenue, well, they beat again 36.7 billion versus 34.8 billion, so that is fairly positive, especially when you consider how this company had performed over the more recent quarters. And when we do take a look, what they are essentially saying is now they are expecting the fiscal year of 2024 adjusted earnings per share of 320 to 350. Now the trailing 12 months actually sits at around negative 3.57, so it is interesting. The only thing they didn't mention within this earnings report is whether or not they are maintaining, reducing or increasing their revenue guidance for the year of 141 to 145 billion. So let's take a quick look now and analyze the company Walgreens Boots Alliance. As you know, they had a horrific 2023, down 31%. Now, 52-week range, they are trading towards the mid to bottom end of this, as we can see. Forward PE sitting at 7.7, and we see the previous yield at 7.51%. It is now sitting around 3-ish, as we mentioned earlier. Now, those investors who have been holding over the last 10 years, well, you would be down around 58%. So let's take a dive into the company, see whether or not this is one that we can see pick up over the next few years. Now, in terms of their top line, as always, we do anticipate 3 to 7% for a company, slow, steady, moderate growth. So 120 billion in 2019, 2023, 139 billion. So we can see, yes, they have increased their top line over the last 5 years. And on a more granular level, we see fairly flat in 2019 to 2020 before a nice jump into 21, pretty much a flat year and then a nice jump. So they have increased it over the last 5 years, but maybe not as consistently as we would like. And we will shortly look at the last 10 years as well, percentage-wise. Now, in terms of their bottom line net income, well, 4 billion reported in 2019. 3 billion net loss in 2023, so not the greatest movement over the last 5 years, and we can see it has been fairly inconsistent, decrease to 2020 before picking up to 2022 and then dropping in 2023. But the positive news is that for 2024, as we mentioned, they are expecting around 140 to 145 billion, so they are expecting an increase, as well as the earnings per share is looking to be an increase from the prior year. Now, in terms of the balance sheet, quick health check, total cash versus total debt. 1 billion of cash in 2019, 739 from their latest report. So they're holding less cash, but still it is a sizable amount. When we compare that to their total debt numerically and directionally, we can see 16.8 billion in 2019, 34.5 in their latest report. So we can start to get an idea of why they are looking to cut, or in fact have cut that dividend, and what they are potentially looking to do, whether it's paying down debt or putting that money towards something a bit more effective for this company and moving it forwards. And we will look at that free cash flow payout soon to see whether or not they were paying out more in dividends than generating in future free cash flow. Now, in terms of the total return, well, we'll just quickly analyze some other companies. We have Tesco and we have Dollar General, as well as a few other well-known in the drug retail industry. Now, 2013 for Walgreens, even if you were reinvesting those dividends, you can see you'd be down 26%. However, do note there were a few of their competitors that have a fairly strong 2013. Now, when we maximize that to the last 5 years, again, one of the worst, in fact, the worst performing, not just year to date, but also the last 5 years, down 52%. So something just to bear in mind, but as always, past performance is an indicator for the future, and this could potentially be a turnaround play, especially in my opinion, what is a positive move for the company in cutting that dividend. What are the institutions doing? Well, 58% institutional ownership. We see around 1.8 billion worth of outflows in the last 12 months. Same period, we see 2.59 billion inflows. So they are buying more every quarter. And what's interesting to note, over the last 4 quarters, we do see that. We see more buying by the institutions than selling. And it'll be interesting when we get the Q4 numbers to see whether or not institutions are now favorably adding more of WBA shares to their portfolios. Now, when we look at the dividend safety, now this isn't updated for the drop, but it was something that we can see was coming. We did discuss this on previous episodes. As always, if you do want to be kept up to date with any dividend potential cuts, do hit that subscribe and bell button so you don't miss out. So now the new yield will be around that 3 to 4% mark. It was around 7.51% earlier. Market cap then around 22 billion, a large cap company. When we look at some recessionary metrics, well, they increased the dividend during the last recession, plus 5.6%, so above average growth, but they did also outperform the S&P with a negative 44% return versus the S&P's negative 55%. Now, dividend growth, unfortunately, in 2024, at the beginning, they have cut their dividend, but we can see over the last 20 years, they were increasing at double digits year on year. It'll be interesting to see how those dividend increases come out over the next few years following this dividend cut, and it is something we'll discuss shortly. So as I mentioned, they were 2 years away from becoming a dividend king. They were a dividend aristocrat as they were increasing their dividends for the last 25 years or more. And we can see, unfortunately, this will now go to zero as they did have 92 years without a reduction to that dividend. Now, dividend yield theory, now it isn't one that we can use at the moment, although we do see this new yield at 3.91%, so it is below the 5-year average, but given that cut, this isn't a model that will be relevant for Walgreens, and as well we can see their forward P now sitting at around 7.6, it is below the 5-year average, but given that huge dividend cut, this probably isn't relevant this month. Maybe in the next year we can come back and look at this model for Walgreens. Their current PE now at 7.6 is well below that consumer staples at 19.8. Now, in terms of the free cash flow payout, and this is one that I mentioned, if you were paying attention, you'll understand now, they were in 2023 paying 1,175% more in dividends than they were generating in free cash flow. And as I always mention on this channel, it is incredibly important, ignore the earnings, because if you were looking at that solely in 2023, you would have not seen this coming. So do essentially pay attention to the free cash flow. That is what I personally do. And we can see in 2024, it'll be interesting to see now with that dividend cut, what that free cash flow payout looks to be, because if it is still very high, there could be another dividend cut coming their way. Free cash flow per share, well, $2.92 in 2014, 16 cents in 2023, and as we just ran through, they are expecting 2024 to be around that $3 to $3.5 mark, in fact, so an increase even from the year before 2022 as well. Sales growth, well, it is one thing that is fairly inconsistent. We do actually see some good years of double-digit growth. We see 2019 where it was negative, but at least in 2023 it was above that inflation of 4% that we always discuss throughout the episodes. Total sales then, they have nearly doubled it from 2014, but we do see from around 2018 it has been fairly flat. 2024 they are expecting around 141 million, or billion in fact. So this isn't a company that is going to be growing massively. It is just about, when we look at that valuation model, whether or not there is value to be had there. Shares outstanding. Over the period, they've done share buybacks, returning excess cash to investor pockets, but they've also done share issuances, diluting your position. We do see the net performance, though, from 2014 to 2023, where they have bought back around 130 million worth of shares. ROIC, as always, 10% or more is what I ideally like to see. Gives me faith that management are able to effectively allocate their capital, but over the last 4 years, unfortunately, we do see it below 10%. Something just to keep in mind. Realistically, it does, in my opinion, have a good essential measure of management and their ability. Operating margin, now this is a big red flag indicator, as well as that free cash flow margin. You want to see around 10% or more. The fact that their margins are getting squeezed more and more, and if you anticipate in 2024 that the consumer will also be stretched in their spending, then it could be a signal to not buy this company. At 2%, if it starts to come down, they'll essentially be making a loss. 2023 free cash flow margin at 0%. It is a worry, something just to consider for 2024 and beyond. Now, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us, one, the balance sheet strength as well as that dividend safety. These numbers show us the number of years it would take the company to pay off all of their debt net of cash on hand. 2023 at 3.29, it is slightly above the 3 that we like to see. 2024 expected to go higher, although we did see a dividend cut, so that should help relieve some of the stress on these numbers, especially on that total debt amount. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, click on that pinned comment below where you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list. Let's jump into the first model. We have the stock ticker symbol WBA, the earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds, giving an intrinsic value significantly higher than the current value, so it is a strong sign of undervaluation based on Graham's model. But as always, do bear in mind we don't look at any of these models in isolation and we'll draw our conclusions towards the end. We then have the multiples valuation model. Now we have the stock price, earnings per share, P multiple. We get the average multiplied by the earnings per share of Walgreens. This isn't one that we will use just because I don't think there is much comparativeness between Walgreens as well as these other companies. But if you wanted to include it, the intrinsic value comes to around $62. Now, taking a look at the dividend discount model, unfortunately there was a dividend cut, so we do see the yearly dividends. So moving forward, I would anticipate around a 2% increase. This is purely subjective. Different investors will go for different amounts depending on their investment thesis. If you click on the pinned comment below, you can essentially plug around these numbers depending on your own estimates and judgments. This does give an intrinsic value of $32.64, so we do have another sign of undervaluation. We get onto the third and final model that we're using for today, the DCF model with the free cash flows year on year. Average growth rate just above 6%. We see the growth rate estimated 1%. Now this is more conservative than analyst targets, but as always, this is what we try to do. Discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. To get an intrinsic value here, we see around 10 to 15% upside, another signal of undervaluation. So as always, the intrinsic value is the average of the models that we've used. For today's episode, it will be these three, and it comes to $35.81. Don't forget, smash that like button, hit that subscribe and bell button if you want to be continually notified of these videos. Margin of safety that we typically start off with, 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. If we move this to 15%, it is a buy up to $30. And at 20%, we can see a buy up to $28. And at 25%, around $26.86. Now, we do see some significant margin of safety for Walgreens, but it really does depend on your investment thesis, whether this is one you want to hold in the long term in your portfolio or a value play. In terms of what Wall Street say, well, they believe the share price over the next 12 months to have some nice upside, as we can see here, around 25%. So in conclusion, we see around a 25% margin of safety for Walgreens with around 25% upside per Wall Street targets. As always, let me know your thoughts in the comments below. Personally, I do see this as a positive move, especially when we saw that free cash flow payout. They were paying a significant amount of their free cash flow in dividends, well above 100%. So I do see this as a positive move, and it could be one that could be a great value play over the next few years, depending on your investment thesis for this industry as a whole. Personally, this isn't one that I want to touch. I do prefer investing in higher quality companies. But as always, let me know your thoughts below. If you enjoyed the episode, smash that like button, hit the subscribe and bell button, and also click on that pinned comment below if you do want to run your own company through the stock valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, have a great day and catch you on the next episode.